Welcome back to the Capital Flows podcast. I'm going to use this session to explain and break down the ideas that I just published in the macro report. And the ideas are as follows. I laid out how the geopolitical context exists today with all of the major global players, how the recent tariff developments fit into that, how those dynamics frame trades, the actions of corporations, and then also connect it down to how do we think about this in positioning in markets. And so anytime we go through the process of developing a thesis, an idea, we always want to start at that big picture level and then bring it all the way down in a clear connection to specific tangible insights. And so if you go to the Capital Flows Research website, capitalflowsresearch.com, you can throw your email in here. You'll get all the updates that are coming out every day. And then if you come right here to the most recent article that is published, all the educational primers are here. The categories for reports are laid out up here. We're going to be in the macro report section, or the most recent one. And that is going to be right here, the comprehensive macro report. And this breaks down the most recent reports, or the most recent research and insights that I've laid out. And I want to spend some time on the visuals that I laid out that depict the scenario analysis and changes in markets as they connect to tariffs. So the main idea in the global context that we're in is that when prolonged periods of stability occur, they shape the beliefs and worldviews of a generation. And what we have seen is over the last 40 years, there has been an extreme degree of complacency on every level in the United States. And we are seeing this across every major industry, whether it's just-in-time inventories, whether it's in defense, whether it's in education, especially in Silicon Valley. We're seeing an entire generation of software engineers, who have developed a lot of, products and ideas that are based on kind of the safety of the world that we live in the United States. The fact that we have this exceptional, geography that keeps all major foreign powers away in terms of the naval strength of the United States, protecting the United States and all the bodies of water that surround us. And then also just in terms of the stability that we have seen really since World War II. And so the geopolitical context that we're in now is that the conflict between the United States and China is intensifying. And this is happening as sanctions are still on Russia. I think a lot of people forget that. And so we're seeing the ongoing war in Ukraine and also into the Middle East. And a lot of these things are coming to a boiling point. At the same time, you have all of these interdependencies with trade. And global trade and tariffs are taking place in this context. And I think that's really key to remember, that the complacency in the United States is taking place where other countries are trying to actively take advantage of that, right? It's actively trying to exploit the downsides and limitations of the political cycles that we have in the United States. And so the greatest extreme in terms of markets that I see today is thinking that there is a binary extreme, meaning that it's either one or the other. We're either going to go into an inflationary reacceleration like the 1970s or a 2008 type recession. It's only one of the two, and nothing else basically matters. As long as you manage that risk, then we're fine. And what I lay out in this report is that that's really not the big picture case of what is likely to happen. And understanding the underlying drivers actually begins to frame how the tariffs are likely causing a change in the composition of the economy as opposed to an outright inflationary or disinflationary spiral. And so the goal of the report is to lay out all of these things. So I lay out the geopolitical context right here, the fact that we are seeing strategic leverage now in supply chains, currencies, semiconductors, just as much as in troop movements. And there are three primary ideas that I think about in this context. So the United States is providing, support to Ukraine without directly being involved in the war. And it's also pushing controls on China. And at the same time, America still remains entangled in that manufacturing world, right? And so what you're seeing is the US or other countries involved in a kind of proxy war at the same time that they had economic dependencies and imports and exports relationship with that actual country. I mean, just the fact that, Russia is, actively fighting in Ukraine, and then it's still exporting oil to China and supporting them and helping them. And then, China is clearly in a trade war with the United States right now. And the United States is, trying to, still sending funding to Ukraine in many different ways, has, especially in the last administration. So you have all of these different ties coming together, and tariffs are just one piece in that. And China is continuing to try to expand its Belt and Road footprint. All of us know this. You have all these complex relationships that are taking place. And then you have all of the chip export controls, all of the AI race that is taking place with DeepSeek, with OpenAI, everything along those levels. Then comes in Scott Bessant. And in the recent interview, I would strongly encourage you to read this or watch this interview. The thing that he lays out is that Scott is well aware that the Chinese economy is running a surplus, which means it produces more than it consumes. And he emphasized the point, they need to be consuming more and not just producing a ton, and they need to bring that back into balance. That means that China can't just say, oh, we're just going to go around U.S. tariffs. Maybe we'll route some stuff through Mexico, through Malaysia, through Vietnam, and everything will be fine. We'll keep getting dollars and everything like that. He is clearly putting pressure on the entire capital structure of the Chinese economy right now. And he laid out that they are in a three-stage process of the tariffs, tax cuts, and deregulation. And when I think about 2025 as a whole, there are some other things on the horizon in terms of the Fed and where we're at with inflation and growth risks. But in terms of catalysts from the policy side, we really want to be watching for tariff announcements, tax cuts announcements, and deregulation. Because on net, right, if you have some type of tariff cuts, you have some tax cuts, the question is really how much are those and how is that changing the decomposition of things? Because Bessant and Trump are clearly trying to thread the needle in some manner so that we don't go into a recession, so the U.S. stays positive in growth and corporate profits don't just take a plunge, that there's a recomposition and a change in the structure as opposed to a complete collapse or melt up. Now, the playbook, and this is what I want to spend time talking about, is the geopolitical regime above translates directly into corporate and market behaviors. And this is the key for thinking about price action and the responses of corporations. As tariffs and trade realignment force strategic decisions onto firms, they face an intertemporal decision, meaning that a firm, a company that has to import things, has to either pay to restructure and gain resilience or defer to maintain optionality. And the chart that I made below represents this. So you have to realize that every firm, they operate in direct competition. They don't always have the luxury of just saying, oh, it's okay, we'll be a long-term thinker and that's fine. That works when you don't have direct competition during the current quarter or current year. Because if a company falls behind by not doing CapEx or by, having some stance toward tariffs, they can significantly lose market share, which can have a self-reinforcing feedback loop to cause the company to go under. So it's not as simple as just saying, well, just, have cash on the balance sheet and stick it out. That's not really how the world works, especially in the type of economy we have with the debt that we have and everything along those lines. So this visual is the initial tariff pressure. And a company has a strategic decision to make. They can invest in domestic CapEx and onshore. They can absorb the tariff as an ongoing cost, or they can delay and just wait. And each of those actions has a risk, and each of those risks are being priced by markets. So if they invest in CapEx, you might have a high upfront cost. You're hedging against the tariff continuing. But if those tariffs are removed, that entire amount that you just spent on CapEx is now at a loss, and you basically have a factory that you don't need, right? And especially if you build that and a competitor doesn't, and then now a competitor has more money than you and can import products at a cheaper price, now you have a problem on your hand in terms of your moat and competitive advantage. And the same thing goes for each of these different categories. And I always like laying things out like this because I always want to see when you have some initial prompt, every single agent in the system is going to have to make a decision that has trade-offs. When you understand those trade-offs, you begin to understand the risks that are being priced into markets and why you get paid to take the other side of a trade. And so all of this is coming down to, okay, we understand the scenario analysis for if you want to invest in CapEx, absorb the tariff, or delay and have indecision. But all this comes down to what's going to happen with tariffs. If the tariffs are lasting longer, if they're on only specific countries, and then just what's the timing of it, right? Because we're going back and forth a lot of times, which, again, that type of uncertainty is not good for any of these decisions. So it's just causing this bleed. Now, when we think about markets' reaction to this, here is how you want to think about the difference in those underlying decisions by corporations and then the market pricing. When you have some type of tariff or policy shock, you have two things that are taking place simultaneously. Number one is in the real economy, there's adjustments taking place, but these are lagging because CapEx can take 6 to 24 months to respond, sometimes longer, depending on what it is. And then you have supply chain relocation, right? And then on the market expectation side, on the short term, you're going to have a positioning unwind and assets repricing. And the market doesn't know what is actually going to take place in terms of the CapEx with 100% certainty or the timing of it. Because remember, the market is pricing short-term changes, right? It can only operate on a specific time horizon. And, especially in the world that we live in today with so many systematic strategies and so many hedge funds that are marked quarter to quarter, a lot of ideas on a time frame over 3 months are just incredibly difficult for the market to price. And so when we think about the real economy and the time frames that are functioning in that in terms of contracts rolling over, changes and things like that, the market is pricing a certain change, but also the speed of that change, right? Because if you find out the CapEx is going to get pushed out from 6 months to 24 months, that's a massive change, right? And the market would move based off of that. So that's why it's important to understand these short-term changes, the time preference and risk tolerance of traders in that, and then how that relates to the underlying constraints that firms are facing. When we find a mismatch, that's when we can begin to identify asymmetry and the risk-reward of assets in these scenarios. So I would encourage you, check out these two visuals that are drawn up and spend some time thinking about the scenario analysis and framework and preparation, the mindset that you need to be able to think through these things. And the rest of the article lays out the aspects of the short-term changes of the real economy and the changes in a certain time frame that we're seeing with that, and it goes into the rest of that. So I'd encourage you to go check out the rest of the article. Everything is laid out in this report. You can go through here, and I'm going to be covering this more and more this week because when we get the geopolitical context right, then the changes in tariffs begin to make a lot more sense. And what Trump and Bessant are trying to accomplish becomes clear. Whether that's through tariffs or they finally cut a deal, we want to be able to find a trade and understand the system in what they're trying to accomplish, because if they cut some type of deal with China, it is very possible that the tariffs get pulled back. But if China actually restructures to more consumption as opposed to production, and the U.S. says, that's fine, we don't need to put any tariffs on you if that's the case, that would be a massive change for markets that they're not expecting at all. And then you have every shade of gray in between there. So check out the report, spend some time going through all of this, go through the different opportunity section. You can always do a free trial and get all the rest of the research there and be able to review everything. And then tomorrow I'll be publishing some additional research. All of it's on Substack, capitalflowsresearch.com. See all the educational articles and everything else. And with that, I'll catch you guys